Okay, we are in chapter number 4, and we're going to be talking about closing entries. If you recall from our overview of the objectives, we have two basic types of accounts. We have permanent accounts, which are assets and liabilities, and the capital account. And we have temporary accounts, which are the revenues and the expenses, and the withdrawal account. And we have a new account that's a temporary account called income summary. And closing entries are the last thing you do to prepare the books and records for the next fiscal period. So what I have here on the board is from problem number 1 in your handout. Problem number 1 is the adjusted trial balance for the marketing company, and I gave you the adjusted trial balance. So after all the adjustments, after the financial statements have been prepared, we happen to have in the marketing fees, we have a credit of $80,000. In wages expense, we have $32,500, depreciation $12,000, rent expense $13,000, miscellaneous expense $8,700, and the withdrawal account $15,400, and the capital account, that's a permanent account, is $80,000. What I need to do is I need to close out the temporary account. So what I'm going to do is I'm going to transfer in a journal entry what we have here in the income account to income summary. And then I'm going to close out these 4 expense accounts to income summary. And then I'm going to close income summary out to the permanent account capital. And then I will close out the withdrawal account directly into capital. So there are going to be 4 closing entries: revenues, expenses, income summary, and the withdrawal account. Now often students will ask me, why isn't the withdrawal account closed out to income summary? Well, because withdrawals, if you remember from our discussion in chapter 1, withdrawals is not an expense. So withdrawals are not closed out to income summary. Withdrawals are closed out directly to the capital account. All right, so we'll be right back and I will show you the closing entries for these individual accounts. Okay, we're back. This is again chapter 4, closing entries, and what we're going to do right here is you can see the fees earned account is a revenue and it's got a credit balance. So to close it out, I need to debit that. And what do? I credit the income summary account. Income summary is only used in the closing process. So I close out revenues. Then I close out expenses, and expenses have debit balances, so to get them down to 0, I must credit those expense accounts. And that's what I've done right here. And then I'm going to debit the income summary. Now, I don't have a dollar figure there. Where do I get that number? Well, I just add up the expenses there, and I see that adds up to $66,200. And that's what I do. And of course, then when I post these accounts, that's bringing the revenues and the expenses down to a 0 balance. Let's move across right here, and at this point in time, the income summary, there's the closing out of the revenues, here's the closing out of the expenses, and I have a credit balance of $13,800. What does that $13,000 represent? That's the net income. That's the difference between the revenues and the expenses. I need to close that income summary. Income summary temporary account only used in the closing process. So I close it out, and I close it out to the capital account. So as you can see here, I would debit income summary, getting it down to 0, and crediting the capital account, increasing it by the net income. Now the last thing I will do is close out the withdrawal account. Withdrawals had a debit balance, so I must credit withdrawals to get them down to 0, and I debit the capital account for $15,400. All right, we're going to stop right there, and I'm going to show you, once we post these accounts to the ledger, what the ledger accounts look like. All right, so here we have the ledger accounts that we started off with, and I'm going to now post those journal entries we just looked at. The first one was closing out the revenues, and I debited the fees earned, and I credited income summary for $80,000. So you can see that temporary account is closed out to 0. I closed out all the expense accounts. So let's see, I credited $32,500 for the wages expense, that's to 0. The depreciation expense was credited for $12,000, that's now down to 0. The rent expense was credited for $13,000, that's now down to 0. miscellaneous expense credited for $8,700 down to zero. And the debit to that second entry was right here, $66,200, which gave me a balance of $13,800. And I have to close that out. It's closed out to the capital account, so I debit income summary. Down to zero. It's only used in the closing process. And I have $13,800 in the capital account. I've got one temporary account to close out. It's right here, and that's the withdrawal account. It's got a debit balance. To get down to zero, I've got to credit that. And what do I debit? Right here in the capital account. Zero. And now, what is the balance in the capital account? The balance happens to be $66,900. That's the ending capital balance. That's actually the balance that shows up on your balance sheet. That's the ending balance in the statement of owner's equity. So there's the closing process. 4 journal entries. The way I normally test this is I actually ask you to do the closing entries, and usually I will ask you what the balance in the capital account happens to be.